Hello, everyone. This is Jeff Goyette Jr. with Dakota Wealth Management, and I am here to bring you your much awaited April 2025 market update. Let's jump right in after some disclosures. All right, so not since 2020, March of 2020, have we needed to provide a timeline for the events that happened in a single month. But of course, as we've all experienced, this month was turbulent. We had a tariff announcement and Liberation Day on April 2nd, which applied 10% tariffs globally on imports to the U.S. Much of the tariff rates were elevated way beyond 10%, which spooked the markets going into April 3rd, and the market dropped largest single day drop in recent history of 6.65% that following day. 1 week from Liberation Day, Scott Bessent announced in the White House lawn that there will be a 90-day tariff pause, but he did say that China will not be part of the pause. And then on the 10th, the markets rallied on the news that we were going to have a 3-month pause. China, the reciprocal tariffs really started on April 11th, where they now are at 145%, at least the U.S. is. And then on April 17th, we had some non-tariff news. We had the Fed keep rates at 4.25% to 4.5% at their target. Bessent then confirmed on April 20th that China will not be excluded or would be excluded from the 90-day pause. And then we quickly got into corporate earnings. So earnings season began, and they were stronger than expected. Really, it wasn't about the first quarter's earnings. It was about what the CEO and the C-suite said about guidance going forward, given the tariff policies. And then on April 30th, and since then, the markets have begun to recover. So just to take an overview of what's been happening, of course, it was a whirlwind month in April, and the S&P 500 nosedived 18% from its February high. A lot of that was bolstered enthusiasm for what the Trump administration would do for markets, but it's only rallied since then 14%. The rebound has been driven by growing investor optimism, albeit relatively, because optimism was not optimism a few weeks ago, and trade talks with the U.S. Have begun taking shape. Earnings also have provided support. Most of the companies were beating their first quarter profit estimates, which were set in place before the tariffs. Like we said, guidance is going to be the key factor in earnings, and a lot of those companies withdrew their guidance because of the uncertainty that remained. Economics. This is maybe the most important part of this presentation. The labor market remains robust. We added 177,000 jobs in April, and the unemployment rate held steady at 4.2%, which is nearing full employment. 4% would be full employment. Layoff activity hasn't increased, but continuing jobless claims have recently jumped. This suggests that companies are retaining their current workforce, but labor conditions are slowing as job seekers are finding it more difficult to secure new employment. It's just really difficult and capital intensive to go out and hire new employees at this time for those companies. Of course, in the headlines, fears of tariff-driven economic shock have eased as the U.S. administration intensifies efforts to secure new trade agreements. As I do this presentation, the U.S. had just secured an agreement with the U.K., and it seemed like it was equal parts beneficial to the U.K. and the U.S. Our take here is that the labor market continues and will continue for at least a few months to show signs of resilience, as the tariff outlook has not harmed the workforce conditions at most U.S. companies. There's been a slight decline in manufacturing output, as to be expected, but services are a larger share of the U.S. economy, and these sectors are continuing to expand. The Fed is unlikely to cut interest rates for the next few months. They did not cut earlier this week. If the labor data remains steady, and they are dual mandated, they look at unemployment rates and inflation. That is what they key in on, and the data is not suggesting that they should cut anytime soon. So to go through some of the key takeaways here. Short-term volatility driven by tariffs and policy, of course. Fed remains cautious and inflation is cooling, but the consumer sentiment is weak, at its weakest since, I think, 2017. Diversification and defensive positioning are recommended and required, really, in this scenario. That's what we bring to the table. And we've gone through all these other key points. I'll leave them up for you to hear. But what is important is the only thing that is certain in this world of uncertainty is that we are going to do the right things for you, given your goals, what your outlook is, and what you need to live a long, happy life financially. So let's jump into one takeaway I want you to have is domestic infrastructure and manufacturing spending over the past several months. There's been commitments by a number of companies to deploy capital in U.S. infrastructure. So for a few of them, Project Stargate, which is OpenAI, that's ChatGPT, $500 billion in the AI infrastructure space. That comes from SoftBank as well. You saw Masa Son and Trump commit to that before Inauguration Day. Apple did the same thing, pledging $500 billion over the next 5 years in U.S. manufacturing and training. And the list goes on. What I'm trying to illustrate here is that there is an immense amount of spending, capital intensive, and creating manufacturing here in the U.S. that could bolster our economy for years to come. So although the news may feel uncomfortable at times, and sure has on our side, diversification and the long-term trajectory of the U.S. is still our core theme. This has been a wild swing of a month, and I am happy to say that the market has rebounded nicely. We will be bringing our attention to any details that come out regarding trade, Fed changes, and market changes as they arise. So if there are any other questions, please call me. I would be happy to discuss your portfolio because I can't go into details about your specific portfolio, of course, on this. But have a wonderful day, and I appreciate you taking the time to listen. Thank you so much.